How much of your investment gains went to taxes last year? The exact dollar amount. If you don't know, you're not alone. Most people open an account, put money in, and never once ask whether the container they chose is quietly eating into every dollar of growth. That question, the container question, is what this whole video is about. 2 accounts, 1 retirement, 1 brokerage, same person, can open both. But the order you open them in, and the order you fund them in, changes the math on the other end by 6 figures, sometimes more. And right now, in 2026, with the One Big Beautiful Bill Act locking in tax rates that a lot of people still haven't adjusted to, the math just shifted again. But the math works the same whether you read about it in April or stumble on this video in November. The structure doesn't expire. Before we get into any of this, I want to be upfront. I'm not your financial advisor. I don't know your tax situation, your income, your debts, or what keeps you up at night. Everything here is education, how the system works, what the trade-offs look like. What you do with it is entirely your call. Here are the 2 accounts. A Roth IRA, you put in money you've already paid income tax on. It grows. You don't pay tax on the growth. You don't pay tax when you take it out in retirement. According to the IRS, as of November 2025, the contribution limit for 2026 is $7,500 a year if you're under 50, $8,600 if you're 50 or older, and there is an income ceiling. If you're single and your modified adjusted gross income is above $168,000, you can't contribute directly at all. Below $153,000, you get the full amount in between. It phases out. A taxable brokerage account, no contribution limit, no income limit, no age restriction on withdrawals. You put money in, you invest it, and every year you owe taxes on dividends and any gains you realize. Long-term capital gains, meaning assets held over a year, are taxed at 0, 15, or 20%, depending on your total taxable income. According to IRS Revenue Procedure 2025-32, the 15% rate for single filers in 2026 kicks in at $49,451 and runs up to $545,500. Below that, you pay 0. Short-term gains get taxed as ordinary income. The IRS doesn't care why you sold. It cares when you bought and when you sold. That is the whole framework. Same money, 2 different containers, 2 completely different tax lives. Now meet 2 people. Reese, 26 years old, works in project management at a mid-size logistics company outside of Charlotte. Salary is $68,000, no student loans left, $11,000 in a savings account. Reese has been meaning to start investing for about 14 months. And Finley, also 26, marketing coordinator at a healthcare nonprofit in Columbus. $65,000 a year, about $9,000 saved, same story, ready to start. Just hasn't started. Both of them sit down in the same week and decide to put $500 a month into the market. Reese opens a Roth IRA. This is the decision most personal finance content tells you to make, and honestly, in a lot of cases, the reasoning holds up. Reese's $500 a month adds up to $6,000 a year, which is under the $7,500 cap. Income is well below the phase-out. Everything qualifies. The money goes in after tax. Reese already paid federal and state income tax on that $500 before it ever hits the account. But once it is in, it grows tax-free, not tax-deferred, tax-free. Dividends reinvested inside the account, no 1099 at the end of the year, no capital gains calculation, no tax drag. Here is the part that matters most and the part most people gloss over. At 7% average annual return, Reese's $500 a month for 35 years. That is from 26 to 61, turns into roughly $900,000. Total contributed out of pocket, $210,000. The rest, about $690,000, is growth. And in a Roth IRA, that $690,000 comes out tax-free zero, every dollar. Nobody talks about this part at parties, but it is the kind of number that sits in the back of your head at 2 in the morning and won't leave. Now Finley opens a taxable brokerage account. Not because Finley doesn't know about Roth IRAs. Finley Googled it, read a few articles, but also read that brokerage accounts have no withdrawal restrictions. And Finley's not sure about locking money away until 59 and a half. Might need it for a down payment, might need it for something else. Flexibility 1. Same $500 a month, same investments, same 7% average return. But every year, Finley owes taxes on dividends and on any gains realized inside the account. At $65,000 in salary and a standard deduction of $16,100, Finley's taxable income starts around $48,900, which lands in the 12% ordinary income bracket. But as investment income stacks on top of that, a growing share of qualified dividends and long-term gains falls into the 15% capital gains rate. Over 35 years, as salary grows and investment income compounds, the 15% rate covers most of the picture. Here is where the numbers start to separate, and this is the part that most comparison articles skip entirely. Tax drag. Every year, roughly 1 to 2% of Finley's returns get shaved off by taxes on dividends and distributed capital gains. That doesn't sound like much, 1%, maybe 1.5%. But compounded over 35 years, that changes everything. Let's run it. Finley, same $500 a month, same 35 years, same 7% gross return. But net of tax drag, Finley's effective return drops to roughly 6%. The ending balance, around $713,000. Total contributed, still $210,000 growth, about $503,000. And unlike Reese, Finley will owe capital gains tax on a significant portion of that growth when selling. If Finley sells at the 15% long-term rate on, say $400,000 in net gains, that is another $60,000 in federal tax alone, state taxes on top of that, depending on where Finley lives. Reese's account, $900,000, tax-free, on withdrawal. Finley's account after all taxes, somewhere around $640,000. The gap, about $260,000. Same person, same income. Same discipline, same monthly amount, different container. That is not a rounding error. That is a house in a lot of American cities. And no one ever frames it this way. Every brokerage platform, every fintech app, with a slick interface. Every investing made easy ad you've seen on Instagram. They all make it extremely simple to open a taxable brokerage account. One tap, funding in minutes, it is the default path. And every one of those platforms collects a fee whether you're in a Roth or a brokerage. But none of them make money by telling you to slow down and ask which container is right first. The brokerage account is the path of least friction, and that is not an accident. You've set up an auto transfer on the first of every month, $500 from checking to your investment account. You watch it go through, you feel responsible, you close the app. That feeling, that sense of doing the right thing, is real. But the container that money lands in determines whether you're building wealth or building wealth minus a perpetual tax leak. But here is the part that should break your brain. The Roth IRA isn't automatically superior. And if I just left it at that $260,000 gap, I'd be doing the same thing every lazy comparison article does, giving you half the picture and calling it education. Because Finley's brokerage account has something Reese's Roth doesn't. Access. Reese's contributions, the actual dollars put in, can come out of the Roth IRA anytime without tax or penalty. That part is true, but the earnings, that $690,000 in growth, are locked until 59 and a half, and the account has to be open for at least 5 years. Pull earnings out before that, and you're looking at income tax plus a 10% penalty. There are exceptions like a first-time home purchase up to $10,000, but those exceptions are narrow and capped. Finley can sell any position in the brokerage account on a Tuesday and have the cash in a bank account by Thursday. No age requirement, no 5-year rule, no penalty, just the tax bill on gains. And that flexibility isn't theoretical. At 31, Finley finds a condo in Columbus, needs $28,000 for a down payment, sells some positions in the brokerage, pays about $3,000 in capital gains tax, moves in. Reese at 31, finds a similar place in Charlotte, has about $41,000 in the Roth, could pull out the contributions, roughly $30,000 at that point, penalty-free. But that is $30,000, that will never compound tax-free again. The Roth IRA has no do-overs. Once you withdraw, you can't put it back. Reese leaves the money in the Roth and keeps renting. The system doesn't punish Reese for being responsible. It just quietly prices the cost of discipline in years spent watching other people's lives move forward. Let's jump ahead. Both are 36. Finley's brokerage account, after the condo withdrawal, has recovered and sits at about $195,000. Finley also opened a Roth IRA at 32 after a coworker explained it over lunch. 4 years of contributions at $500 a month. About $28,000 in the Roth now. Total invested assets across both accounts, roughly $223,000. Reese's Roth IRA, untouched for 10 years, has grown to about $112,000. No brokerage account, no other investments, just the Roth. From one angle, Reese is in better shape. That $112,000 is entirely tax-free on the other end. From another angle, Finley has twice the total invested assets and a condo with equity building. There is a version of this story where Reese is the hero and a version where Finley is. The real answer depends on what happened in between. The decision tree isn't which account is superior. It is which account is right for the next 5 years of your specific life. Here is one framework, not advice, just structure. If your income is under $153,000 single, you qualify for the full Roth IRA contribution. If you have an emergency fund that covers 3 to 6 months of expenses, if you don't anticipate needing this money before 59 and a half, the Roth is hard to beat on pure long-term math. You are locking in today's tax rate and never paying again. If you're saving for something in the next 2 to 7 years, a down payment, a career change, a move, if you've already maxed your Roth and want to invest more, if your income is above the Roth phase-out and you're not doing a backdoor conversion, the brokerage account gives you something no retirement account offers, the ability to change your mind without a penalty. Both accounts let you buy the same things: index funds, ETFs, individual stocks if you want, bonds. The investment options inside are nearly identical. The difference is the tax wrapper. That is it. Same engine, different chassis. One chassis has a lock on the door, the other one doesn't. And under the One Big Beautiful Bill Act, the tax rates you're working with in 2026 are permanent now. The 7 brackets 10 through 37% are locked in. They're indexed to inflation. They're not sunsetting. According to IRS Revenue Procedure 2025-32, those brackets adjust annually for cost of living, but the rate structure itself is fixed. That changes the Roth calculus slightly when the TC-JABA rates were set to expire. There was an urgency argument: contribute to a Roth now, while rates are low because they might go up. That argument is weaker now. Rates are staying, even if you find this video in 2028 or 2030. The bracket structure is the same. The contribution limits will adjust for inflation, but the logic holds. It feels like standing in front of 2 doors that both lead somewhere reasonable, and being told you have to pick one right now. You don't. You can open both. Most people do, eventually. The question is which one you fund first with the money you actually have this month. Reese at 40 has a Roth IRA worth about $211,000. 14 years of untouched tax-free compounding. No condo, no brokerage account. Still renting. But that Roth is a fortress, on the other end, at 61. It is projected at somewhere around $900,000, all tax-free. Finley, at 40, has the condo with about $61,000 in equity, a brokerage account at roughly $240,000. A Roth IRA started 8 years ago at around $62,000. Total net position across everything, about $363,000. More diversified, more flexible, but a meaningful portion of that brokerage growth will be taxed on the way out. And this is where most people stop doing the math. Reese's single account at $61,900,000, tax-free. Finley's combined position at $61,000, projecting forward with the same assumptions. Brokerage at roughly $610,000 before taxes. Roth at about $235,000, condo equity at roughly $110,000. Total, about $955,000 gross. After estimated taxes on brokerage gains, around $870,000 net. The gap between them shrank from $260,000 at the simple comparison to roughly $30,000 in real lived financial outcomes, because Finley built a life with the flexibility that account provided. And the Roth IRA caught up as a secondary engine. Reese optimized for one variable. Finley optimized for the whole picture. By any honest comparison, both of them did this right. Both started at 26. Both put in $500 a month. Neither one got rattled in a downturn or cashed out early. The only difference was the first door they walked through. And the system doesn't give either of them a trophy, it just gives them different versions of okay. A Roth IRA is a 35-year promise you make to your future self. A brokerage account is a tool you can actually hold in your hands right now. The answer to which one you open first is not a universal truth, it is a mirror. It reflects what you need your money to do in the next 5 years, not the next 35. The last snapshot. Reese and Finley, both 61, same city now, as it happens. Reese is at a kitchen table, looking at a Roth IRA statement that says $900,000. Every penny of it tax-free, no state tax, no federal tax, no required minimum distributions ever, clean. Finley's at a different kitchen table, 3 account statements fanned out. Brokerage, Roth property tax assessment, the total is higher on paper but messier in practice. Some of it will be taxed, some of it is tied up in walls and a roof, and some of it, the Roth portion, is just as clean as Reese's. 2 people, same starting line, same commitment, different containers, different lives. The question was never which account is superior, it was always which life you were building around it.